Good morning, everyone, and thank you very much for joining me today on this webinar. My name is Tom Jaffrey. I am the Business Development Manager for Blackfinch, covering the Cotswolds region. And I have titled this webinar today, "The Miracle Isn't That I Finished, the Miracle is That I Had the Courage to Start." Now, there is a good reason why I've done this. So for those of you that know me and for those of you that don't, I've got a number of passions in my life, my family being one of them, my career, so my client base, which is the financial advisor community, but also running. I'm a big runner. I've run a couple of marathons. I will be running the London Marathon this year. And one of the reasons that I got into running, long distance running, was due to a man called John Bingham. He's a columnist for Runner's World. And he has coined this phrase, this sentence, and I think it runs true when talking to advisors about tax advantage investment products, specifically those that we're talking about today. And really, John Bingham he's not an athlete. He's not come from a specialist background, but he's really given runners the confidence and the education to help them conquer their goals and objectives when it comes to running. And that's what I'd like to do as a BDM, specifically focused on tax advantage investment products, which I hope we're going to do today. And along the way, I'm also going to weave in some marathon anecdotes as well. Before we start, just some housekeeping rules. There is a Q&A function on the Zoom. If you do have a question along the way, if you put it on the Q&A function, I can then cover it at the end. This is the important information. It's here to refer back to it if you need it, and we will be sharing the slides post the webinar. We will be talking about high risk investments, and these are the risk warnings that come with advising on high risk investments. So what are we going to talk about today? What's the agenda? This is CPD qualifying, and our agenda is as follows. What is the market data telling us about VCTs, and why is this important to advisors? We're going to look at VCTs and diversification specifically. We're also going to touch on helping advisors prepare to use enterprise investment schemes. And then our final item is why now may be the time to consider AIM investments. And for this section, I will be joined by one of our product specialists to help us talk through why now is a good time to consider AIM investments. Now, this agenda is designed for this time of the year. We are approaching tax year end, where there are clients looking at EIS, VCTs, ISA investments, where you might be investing into AIM. So that's why this agenda has been curated. So to start, and this is my first marathon analogy. So last year, 50,000 people ran the London Marathon, a huge number. But only a small percentage of those ran a time sub 3 hours 30. Now that's the time I'm looking to get this year. I've done a 3:32 before, so I'm looking to shave 2 minutes off my time. But only a small percentage of those runners, of those 50,000s, can run it in or have run it in last year below 3:30. Now in the UK, we've got around 5,000 advisors in the UK, and only a small percentage of those advisors advise on tax advantage investment products. Now, there are huge reasons why only a small percentage of advisors advise on tax advantage investment products, and there are nuances to every case, of course. But really, what I want to do today is try and give you guys some confidence on using tax advantage investment products to hopefully increase that percentage. So, the winner of the first ever Olympic marathon, which happened on the 10th of April, 1896, was a gentleman called Louis Spridian. And he was a Greek water carrier, and quite impressively, he ran a marathon in 2 hours 58, which is such a quick time, and he's probably running it in sandals. Now, the current world record holder is a gentleman called Kelvin Kipton, sadly passed away a couple of weeks ago, actually, and he holds the world record of marathon running in 2 hours 35 seconds. Now, like the nuances around the advisor community on who manages and who advises on tax advantage investment products, there are so many nuances around why we are able to run marathons much quicker. diet, training plans, technology. When I first started running, I just ran in the same shoes I'd always had. I ran the same old pair of Asics that I've had for about a decade. And I just thought that I'd be able to run using that pair of shoes. But actually, never got quicker, and I actually started getting injured a lot. And I went to see a foot specialist, a specialist who tracked and ascertained key data points on your foot, and was then able to recommend a suitable trainer that was designed specifically for my running style and for my running foot. And actually, after doing that, I was able to run much quicker, and I'm able to run much more effectively and efficiently and get injured less. So why am I telling you this? Well, I think when it comes to VCTs, the advisor community may make similar mistakes, because advisors, I think, can be guided by what they're familiar with, what their peers do, and often not what the data is suggesting and what the data is telling them. Advisors that I come across often presume that VCTs are a product only used for a lot of planning opportunities or for the very high net worth or ultra high net worth clients. But actually, when you start looking into the data, when you look at HMRC's 2022 Venture Capital Trust statistics, which were published in Jan 23, those investing £10,000 or less actually represented the largest group of VCT investors. So that's actually a relatively small amount of money that's being invested. And that's it. In addition, the other data point that I think is really interesting is the average age of VCT investor is coming down. So recent data from the Venture Capital Trust Association showed that the average age of the current VCT investor is coming down from 67 to 56. That's, again, really interesting. So it's not just the ultra high net worth investors who are slightly older, who've got access to more capital. It's younger investors investing in smaller amounts are accessing VCTs. So from this data, you can argue and you can ascertain that advisors are using VCTs as part of their annual process for a larger proportion of their client bank. VCTs are not just used for those one-off client planning opportunities. Now, why would that be the case? Well, if you look at the investment theory, it's really interesting. So VCTs, investing in venture capital, that is an asset class that is uncorrelated to your listed equities, your traditional fixed income assets, or other alternative assets. And that uncorrelated nature of a VCT can actually help boost your long-term risk-adjusted returns into the future, because that uncorrelated asset is offering you diversification. Now, it's not just me from Blackfinch saying this. There is a report written by a research company called Hardman & Co., where they go into quite a lot of detail about how adding in venture capital into an investment portfolio, even in just a small amount, can help boost long-term risk-adjusted returns by around 0.5% to 1% per annum. So that's probably one of the reasons why that mass affluent client base, the younger investors, are accessing the VCTs, because not only does it come with the tax relief, they also help them boost their long-term risk-adjusted returns. Now, when I started training for my first marathon, I believed that all I needed to do was run loads. Just run loads all day, every day, and I'll be able to achieve my objectives. And actually, it's not like that at all. It's really important to have a balance in your training plan. So a balance, a diversified training plan. You want to do long runs, you need to do short runs, you need to get into the gym, cycling, swimming. Lots of variety in your training plan actually helps you get quicker come race day. Now, I think it's the same with VCTs. So advising on just one VCT or a few VCTs may mean that you don't have balance inside your portfolio. But it can be forgiven that advisors believe that VCTs are all treated equally or created equally to deliver the same client outcome. They're the same investment structure, they come with the same tax reliefs. But actually, when you start looking closely at VCTs, they all have different investment strategies, different styles, different portfolio companies, different charging structures, different concentration risks. So having a balance of VCTs in your portfolio or for your clients' portfolios is likely to deliver better client outcomes into the future, in addition to delivering on those tax reliefs that come with VCTs. Now, the data around this shows that more investors are accessing a greater amount of VCTs. And the data that I draw on comes from the Wealth Club. So the Wealth Club is a tax advantage investment platform, and they allow investors to access VCTs and other tax advantage investment products on their platform. And the data that comes out gives us a good understanding of what investors are doing in this space. So data from 2022-23 on the VCT transactions shows that 12% of investors carried out 7 or more VCT investments, and 17% did between 4 to 6 VCTs. So it's showing us that there is a good amount of investors that are actually preferring diversification on their VCTs. Now, they're doing that because I believe that there's greater choice and availability of quality VCTs out there in the market than there ever has been before. Now, to give you some kind of quantified data on that, I've got a chart here that shows all the major VCTs in the market. Now, this data, or this graph, shows all the major VCTs on the market and also the main market, and it split the VCTs into groups. Now, those groups show the percentage of portfolio companies inside the VCTs that are reducing their revenue, so they've got a declining revenue, got modest growth, which is up to 25% increase in growth, high growth, which is up to 50% increase in revenue growth, or rapid growth, which is up to 75% increase in revenue growth. Now, this data comes from 2023, and it's data on the underlying portfolio companies inside the VCTs. Now, what you can see here is the market is pretty good at identifying growth companies. So the venture capitalists that are offering VCTs, some of which you probably know on there, we're on there as well, show that the market's pretty good at identifying early stage growth companies to invest in. And that's because the UK is a very good fertile ground for early stage venture capital firms to grow. Now, what you can see here is some companies, some VCTs are better than others. They're actually identifying those companies. Now, Blackfinch had a fantastic year last year. And if I just move on here, you can see that we actually came out on top as the VCT that had the highest percentage of early stage growth companies, high growth companies, so up to 50% revenue increase out of all the other VCTs on the market, which is great news for us. We're an early stage, younger VCT, and this is the first piece of really tangible performance data that we can hang our hat on and share with the market, which is fantastic for Ruben and the team that run the VCT. So who do I talk to about VCTs? Well, clearly, if the mass affluent client base is using VCTs to help them get additional diversification, then you can talk to a broad number of clients within your client bank. Perhaps those clients that have done their ISA contributions, they've done their pension contributions, and they're looking for something a little bit different. Maybe they're a high earner and they're looking to reduce their income tax liability as well. Now, with VCTs, because they come with that income tax relief, you can invest into them on a 5-year rolling basis and actually use that income tax relief to help you compound your returns into the future. Now, that means that there are specific types of clients that VCTs can be very useful for. And one of those is company directors. Now, here, this is a table that sets out regular investments into a VCT by a company director over a 10-year period. Now, there's lots of numbers on there. What I'm going to do is just walk you through this worked example, and I am available to come and meet you in person or get onto Zoom and go through this in person if you want to. But hopefully I can just walk you through it now and explain what's going on. So in year one, we're taking a dividend of £80,000, and the dividend tax on that, assuming this company director is a high rate taxpayer, is £17,400. Now, you make a VCT investment in that year of £58,000, and your income tax relief is £17,400. So you wipe out your income tax liability, you have a VCT investment, and you also walk away with £22,000. So in year one, you've got your income tax relief and also whatever's left over after your VCT investment. Now, we do the same thing every year. So we do the same thing in year 2, year 3, year 4, and year 5. And you can see it's an £80,000 dividend. You're making a VCT investment to reduce your dividend tax liability to 0, and then you're walking away with any excess. All quite simple stuff. Now it starts to get exciting in year 6, 7, 8, 9, and 10, because in year 6, we're making the same dividend contribution, paying ourselves the same amount in dividend. We have a same dividend tax liability, and we're making the same VCT investment. But what we're getting the income tax relief, the proceeds of year 1 VCT, and also the excess from your VCT investment and dividend payment. Now, what you're doing there is effectively extracting profits from a business in a very tax efficient manner. And this is something that company directors who are also making pension contributions, perhaps making other investments, can start doing in relatively small amounts and then rack up over time to try and extract those profits from the business. Now, clearly, this example doesn't take into account any dividends that the VCT is paying, any growth that the VCT may benefit from, or any decline in value of the VCT. But if you're doing this in a disciplined way over a 5-year rolling basis, you can really see, just by looking at the numbers, how that income tax relief can help you compound your returns and compound that growth over time. Here we go. Exactly. So here we go. We've just seen in year 6, 7, 8, 9, and 10, you're getting your proceeds from the previous VCT investment, your income tax relief, and also your excess. Now, the other investor that I think is super interested in VCT investments, or where they can be very useful, is your investors who are approaching retirement, or perhaps they're in retirement. Now, they may have relatively healthy estates, like large estates, and they're drawing on their pension to fund their lifestyle. And as they're drawing on their pension, they're paying income tax liabilities until such point as they die, and then their pension, whatever's left, and anything else in their estate passes down to their beneficiaries. Now, with regular VCT investments, what you can do is you can effectively slow or stop the cumulative income tax liability in your lifetime. Now, this is a live example that I worked with a client, with an advisor, and it shows here a client in their mid-50s, has an estate of over 2 million in assets, including property, including pensions, including their ISA and cash, and they're planning to retire at 60. And this advisor is using a cash flow forecast to show the client what their cash flow position and what their income tax position would be with and without an a VCT investment. So on the left-hand side, you've got the base case scenario. And on this base case scenario, you're assuming a £50,000 investment into a VCT each year on a 5-year rolling basis up until retirement, and then it will continue at retirement. Now, for this, we've assumed that there's no growth on the VCT investments over time, and 5% dividends are paid out on the VCT on an ongoing basis, and those dividends are maintained. So on the left, you can see the client's income tax liability, cumulative income tax liability in their lifetime with a VCT investment. And you can see the income tax liability doesn't really creep up that much. It creeps up a little bit, but not that much as the client is drawing on their pension. And that's because they're benefiting from that 30% income tax relief that you're getting when you're making your VCT investment. Now, you've got the same client, same scenario, same assets, but without a VCT investment. And you can see the cumulative income tax position of the client over the same period is wildly different. Now, that shows that there is a significant amount of tax to be saved through going down the VCT strategy route for these retired or planning for retirement clients. And actually, when you start using cash flow forecasting with VCTs, it can be very, very powerful with identifying and showing you how much cumulative tax you're going to pay in your lifetime. Again, this is an example that I've got. I can come and talk to you about it in person, or jump on a Zoom, jump on a call and talk to you about it in a bit more detail. But again, I think it's a very powerful tool in showing you how VCTs can be used for a different type of clients and those in retirement. Now, when you're running and you're running a lot, you get injured. In fact, it's inevitable. At the moment, I'm running 5 times a week. You get tweaks, you get strains. But when you learn about what's causing the injuries, you can understand them, it helps you recover and actually prevents those injuries in the future. Now, in the world of venture capital, such as in the world of VCTs, it's almost inevitable that we're going to get company failures. Sometimes not everything works out, but actually you learn from those experiences, you learn from the failures. Our investment team, anecdotally, our investment team are performing very well, as I've shown in the VCT data, but they've had 2 or 3 company failures since inception. And since those company failures, we've learned from it. We've added and we've amended our investment process. We've now have a different approach to taking companies to the investment committee, and that's all come through company failures. So you learn from it, and it helps you get stronger, helps you get better. And with VCTs, you have a wide variety of diversification inside the VCTs, which often means you don't feel the pain of a company failure. The Blackfinch Spring VCT, for example, its value is derived from a large number of different portfolio companies, not just by a couple of very large companies. But investing in several VCTs can help diversify that investment risk even more. Now, if we're talking about enterprise investment schemes, which is also investing in venture capital, you are investing directly into these early stage companies, and you will feel the impact of those companies when they fail. However, investing in enterprise investment schemes come with more generous tax incentives, more generous tax reliefs. So because enterprise investment scheme qualifying companies come with and benefit from loss relief, you can easily calculate how much you could physically lose if all the companies you invest in do fail or go bust. You could also defer a capital gains tax liability through investing in enterprise investment schemes, or mitigate an inheritance tax liability through business relief, and also reduce your income tax liability from this year or the previous tax year. So although you may feel the pain of company failures more so than in a VCT when investing in enterprise investment schemes, those generous tax reliefs do help you and give you some comfort. The other things to consider when investing in an enterprise investment scheme are: how is your portfolio diversified? So are you investing across multiple companies? Are you only investing in a few? The market average, I believe, is 8 companies in any one tax year. We are looking to deploy into up to 15 companies before the end of the tax year. And we'll be investing all capital before the end of the tax year if applications and cleared funds are received before the 22nd of March. But on diversification, are those companies investing in the same markets? Are the companies investing across several markets at different company stages? Now, with our EIS, we are looking at investing in, as I said, up to 15 companies this tax year across several industries, several sectors, all at different company stages. How quickly are those funds deployed? So again, I think the average is 12 months for deployment. Our standard is 12 months, but this close to tax year end, we can deploy right up until the end of tax year end very quickly. Very important for those clients who are looking to carry back income tax liabilities from the previous tax year. What's the investment strategy? Does the investment manager have a clearly defined, disciplined investment process for identifying early stage companies to invest in? What's their external network like? What is the investment process like? How many stages are there? How do they kick the tires? I think Blackfinch reviews up to around 2,000 companies a year, and we make 10 to 15 companies a year. So that gives you a good understanding of the due diligence that we go through when identifying and investing in the companies inside our EIS. Does the investment manager put external members on the boards of the companies that they invest in? If so, where does that network come from? It is a prerequisite for us. We absolutely put an external member on the board of every company we invest in. That network of external directors comes from ourselves. That network now for us sits at around 80 to 90 external network partners. We call them venture partners. And Blackfinch also invests in every company on its own balance sheet as well. And do founders have an incentive? Are they incentivized to keep driving that business forward, to keep bringing the energy, to keep bringing the life? And are they incentivized to stay there, to keep driving that business valuation forward? Something to look out for when, again, selecting an enterprise investment scheme. Now, when running, for some, it's just about taking part and just getting the job done. For others, it's about enjoying the experience. Running long distance can be very cathartic, can be good for your mental health. For some, it's raising money for charity. But for others, it's all about the time that you run it in. Now, getting the time you want is dependent on many, many factors. The amount of training you put in, your physical capabilities. But the timing of your run is very, very important. And in investments, timing can be everything. Invest early and you might catch a knife, invest too late and you might miss the bounce. Now, with that, I am joined by our product specialist for AIM investments. And Josh is going to talk through how now may be the right time to invest in AIM and why now may be a good time to consider investing in AIM. And really, because is AIM going to be our kicker when finishing our marathon run? So with that, if I could pass over to you, Josh, and we can talk through about why now is a good time to invest in the AIM market.
Thanks, Tom, and good morning, everyone. It's great to be here. I'm hoping there are others on the call the same as me in saying that the only way that I'm going to be making it over the finish line is if Tom drags me the whole way, because I'll definitely be man down after about 5K. However, something I'm much more familiar with are small cap and AIM listed stocks, and this is what I'm going to dig into today. What I thought we'd do is just go back to school, bring in a bit of math to start with, looking at the formula on the screen here. I'm going to use this to get us thinking about investing overall, how it applies to today's markets, and we'll do some history afterwards where I'm going to apply that formula, look back at time into some quite volatile scenarios, what this meant for investors covering the macro as we go. And I'm going to use some nice stock examples to bring everything to life, but more importantly, you should come away with a better understanding of why now might be an attractive entry point for small cap and AIM listed investors. So bringing in the first slide here, and this is just a very simple framework for how we view listed markets at Blackfinch. I'm a simple man that likes very simple things, and I think this is what investing in stocks is all about. So when an investor buys a stock, the goal is to earn a return labeled R on the screen. And this return is typically broken down into different components. The first is listed E, earnings growth. And very simply, you're investing in a company typically because you believe their earnings are going to grow over time and you reap the reward as an investor. You have D, which is your dividend yield. Not all companies pay a dividend, but some can. And of course, very simply, this factors into your overall return as companies distribute their cash on their balance sheet. And finally, delta V, which is your change in company valuation. And this is going to be the one that we spend the most time on today. And it really has been the talking point over the last few years, especially. And I'm going to describe this delta V as a price to earnings ratio. So this is just where you take the current share price of the company that you're looking at, you divide it by their earnings per share. And it's a nice little easy tool used for valuing companies to see if a stock's correctly valued relative to its peers. And just as a quick example, let's say your valuation doesn't change in terms of its PE, which means you're going to buy your company at 20 times earnings. You sell it at 20 times, so you're adding nothing to your return. But the company's still growing earnings at 10% year on year, and it doesn't pay a dividend. So your return is simply given by the earnings growth, which is 10%. And you can swap out these values to give different examples, like your more typical FTSE 100 companies that pay a dividend but not much earnings growth. But the E and D components are what you think of as very traditional financial analysis, or it's the rational form of buying stocks. And as investment managers, we spend a lot of time on the DD of understanding what the earnings growth is going to be and the dividend yield. We'll look at the capital allocation policies, the quality of management, products, services, and so on. And, we're analysing these companies to get that good understanding of E and D. But as many of you know, active managers won't always get that right. There's going to be room for error, of course. It's that delta V that's extremely hard, if not impossible, to predict. Because if you're going to buy a company at, say, 20 times earnings, in 12 months' time, who knows what that collective investor sentiment will be towards a stock. It could change to the up or to the downside, and you really have to almost guess or predict what that's going to be over the 12 months to have a smile on your face and be a happy investor. It could drop from 20 to 10 times for a whole host of reasons, but really at the minute, the driving force has been the macro backdrop. It's inflation, it's interest rates that have driven valuations down. And where are we now? If you've looked at the smaller cap end of the listed market, including AIM, you've seen 20 to 30, 40% drawdowns in small cap stocks, but arguably earnings have been okay. Companies are still paying dividends, and you kind of question, what's going wrong with this R component in the formula here? And it is that delta V that's deflated valuations. If we know that delta V is going to be impossible to predict over a short time frame, you have to look forward with a long-term investment lens. A lot of that macro-driven negative sentiment has worked its way through asset prices for what an investor can pick up. So there's not much more influence to come from delta V on the downside. Obviously, never say never. Stocks can always get cheaper, but it doesn't seem like there's much more room to fall. And if we can't pinpoint when it turns positive, it's important to have that time in the market. We've seen how volatile delta Vs have been over recent years, but your prudent investment manager will ensure they buy businesses with earnings and dividends that are increasing year on year. So even if that delta V doesn't change to the upside over the short term, rational investment decisioning will come through over time. Stable and accelerating E&D will drive delta V over the longer term, and it links in very nicely with clients looking to hold these investments for tax benefits also. But let's dig into it in some more detail. Tom, if you want to jump over to the next slide for me. As always, it's best to put theory into action. And before I explain it in detail, if we set the scene first of all, the AIM market has come on leaps and bounds over the years. It started as a listing of 10 companies. It's over 70 times that now. And when you think of the AIM market, it's very synonymous with small caps in general. So have that in mind as I'm working through the charts here. And I know Tom's already worked on tax advantage investments already, but your client can pick up that additional benefit of holding BR qualifying AIM companies over the longer term as well. But what I want to do is just focus on the fundamentals and market conditions for this call. So with that in mind and working through the chart, I've used the Deutsche Numis AIM Index as a proxy for the AIM market. I've included its forward PE over a 6-year time series, and that straight horizontal line is just the average of that PE over the same period. And this is just a nice way to get an understanding of company valuations. So what I thought we'd do is look at the middle and the right-hand side of the chart. So starting in the middle, as we know, this was the COVID pandemic. It was a man-made recessionary period. We had the immediate shock from closing supply routes to protect the health of populations, and we saw the general market drawdown as a result. And of course, as we know, what happened after that was that notable market rally. I mean, if we're following that line upward, the forward PE rallied from 12 to 22 times, and you had healthcare companies performing well. There was general innovation, a big tech boom, as consumers were forced to adapt to new dynamics like working from home. There were high levels of exuberance and speculation as we start to go to the top of that line there, where consumers just had surplus cash to spend and they couldn't do it through normal means. And anecdotally, I remember I had friends that were coming up to me. They've never invested before, but they wanted to take a stab at Bitcoin at the time, which is arguably one of the most volatile asset types you can invest in. So that kind of shows that the valuations really were above average at this point. Flip it on its head, bring to the more near term, and this is where we are today. We had that large inflationary shock, sharp tightening of interest rates that hit your valuations hard. There were large sways of negative sentiment, and indiscriminate selling hit all types of assets. But as I said earlier, the fundamentals of some of these companies were still strong, but the environment has been more macro focused, and that's what's pulled the PE from as high as 22 times all the way down to 10 within a year. So looking forward, the AIM market is now one of the most attractively priced segments of the UK. It's got one of the lowest multiples we've seen in years. We've seen a strong shift in macroeconomic conditions. If you guys remember that everything rally in November and December, that's almost caused a bit of cautious optimism looking forward. Investors are starting to price in rate cuts throughout this year. Now, of course, there can be bumps on the road, like inflation surprising to the upside, hitting 4% and staying at 4% in Feb, but the general trajectory is downward, and there are still some big base effects to come in here in terms of energy components over the coming months. And this is what everyone's been waiting for. So if the Bank of England hits the target, the 2% target, or the range bound at the very least, they can take the foot off the gas, and that becomes the driver of returns in our view. And if we think about a bear case or a worst case scenario, a credit event or a deeper recessionary period would also be the catalyst, because either way, the Bank of England have done their job. But the fact that we've got such a low base in terms of forward PE shows there's real potential for positive upside market movements. So if we think that's the case, I thought let's dig into small cap and AIM listed stocks if we look back at history. So Tom, if you can jump over. I think first things first, there's a correlation between a drawdown and a hard recessionary period. So obviously, I think that the point for us to look at is the GFC. As you guys know, this was a period of excessive borrowing. We had a major credit event. There were debt-burdened companies struggling to stay afloat. And just looking at the chart, again, I've used the Deutsche Numis AIM index, but I've compared this to its UK large cap equivalent. Everything's on a total return basis. And what I've done is I've shaded in the OBR-defined recessionary period in red. And you can see the difference between large and small cap equity. If you think about why that might be the case, a lot of this can be explained by what's known as behavioral finance. Think about the trough of a recession, the mind of a consumer. A lot of that negative sentiment and actions have already happened. They've sent their ripples and shockwaves through the economy. So your consumer's going to be at peak negativity and they're passing the trough or peak negativity. So what do? You look forward. Macro conditions start to improve. The consumer might have looser purse strings or more money in their wallet. Interest rates fall. And therefore, they're very prepared to take on more risk as things look more positive. And naturally, an investor who's prepared to take on that risk will opt for smaller companies, which is a great catalyst for the share price. And just using the chart, you can see over the space of 2 years from that depth of the GFC, the AIM market returned about 120% relative to large caps 40. And as I said at the start, it's delta V that's driving returns. It's that increase in risk appetite rather than big company earnings growth or a dividend yield. On top of this, bringing a financial theory known as market efficiency. This is a hypothesis in financial economics that states asset prices reflect all available information. So if markets are perfectly efficient, then it's going to be impossible to beat the market as an active manager because everything's reflected in the price. However, are markets truly efficient? We, of course, would argue no. If you compare an AIM stock to a large cap, an AIM-listed stock might be covered by a few analysts, but one of the UK's major energy companies are going to have dozens of analysts looking at it at any one time. So there's going to be a consensus on the forecasted earnings, the trajectory of the energy company. So a lot of this is going to be priced into the stock. But for small caps, there's a great opportunity for price discovery in that an investor can take advantage of a mispriced stock that only has a few analysts looking at it, and that can compound returns over time if you get it right. And that's absolutely where small cap managers can earn their money, and this is evident in the chart. However, as we know, small caps come with more risk. So Tom, if you can jump over for me. Similar as before, AIM versus large cap, all on a total return basis over about 2 years. You can see the sharper drawdown for small cap stocks. And if you pan this chart further out to the right and include 2022, this is absolutely the case as well. By nature of these companies, returns can be volatile, but it pays to be a patient investor. As you can see, the AIM market had about a near 30% drawdown. It was in a sharper manner than large cap. But what I thought was really interesting was looking at when equities rally for listed markets. As you'll notice, both indices start to trend upward a full quarter before this red period ends. And this is really important because equities trade on a forward-looking basis. It gives an indication on investor sentiment, and it shows that markets can bounce even if we're seeing negative data points that would suggest otherwise. And this is almost always the case if we're looking back at past recessions. And some will argue now whether we're there now with current macro trends. We're in our technical recession and we're seeing these equity market rallies. And I think there's definitely a bit of FOMO going around with the price of Bitcoin at the moment and so on. So just following the two lines, you can see the power in holding smaller companies. Your large cap index took about 18 months to break even, but the AIM market's done it in a third of the time. And actually, by the time that the large cap index has reached that point, an AIM investor would have returned an additional 30%. Now, of course, an investor can have a natural blend of both of these market caps in a diversified portfolio, and small caps certainly form a vital part of it. Yes, with increased risk, but it can help give that kicker in terms of returns. And very recently, we've seen a lot of investors go into cash that were attracted to those high interest rates on them. I'm sure you've had a lot of clients having that chat, but we do expect these interest rates to go down. That should help capital flow back into markets and help with this asset price rally. I think a lot of people have been waiting for the right catalyst to present itself, and basically they're dipping their toes in the water before jumping on in. So we know there are some compelling opportunities on offer, and that small caps have the potential to bounce back sharply. What I thought we'd do, if you go on to the next slide, Tom, is just bring an example that brings it all to life. So Renew Holdings are listed on the AIM market. They're a great example for your clients of how long-term earnings growth can be reflected into share price performance, and it can drive Delta V over time. Renew are a solid and dependable business. They've beaten the test of time as they've performed really well through recessionary periods. And it's all down to the business model that suits a buy and hold approach. And actually, it's in both of our income and growth portfolios at Blackfinch AIM. You get a good dividend, but also growth from it. They provide non-discretionary infrastructure services across the UK. Think of them as the ones that are tackling the UK's roads and potholes, or your infrastructure for rails that need to be looked after. Admittedly, I'm sure many of us can agree this definitely needs more work, so there's a solid demand. The kind of activity is somewhat cyclical in nature, but it's absolutely crucial, and earnings are therefore very solid. You know, you've got to keep your lights on and your roads working. These absolutely do that. And naturally, it provides you that long-term shareholder value that helps drive returns over time. And then as earnings per share grows, so does the price. And this is what the chart's reflecting here. I've just taken Renew share price over a 20-year time frame. It includes those recessionary periods and drawdown events that we've talked about. And I've overlaid it with its earnings per share. And you can see the correlation really nicely here. If you just eyeball the bars, which are reflecting the EPS, there's been an upward trajectory in earnings since 2009, and the share price has followed suit. So I think that covers the rational E&D part of the formula that I mentioned at the start. So Tom, if you jump over, let's talk about Delta V. Gamma, this really feeds into the narrative of that indiscriminate selling down across the AIM market. It's a great example of a company that has the potential to re-rate, but even if Delta V doesn't do as it's told and moves upward, it has great earnings growth and a dividend yield, which will drive it over the longer term, like we saw with Renew on the previous slide. These guys, they're a modern telecoms company. They provide new telecommunication services, predominantly to smaller SMEs. There's a lot of demand behind its products, especially with the integration of things like Zoom and Teams that are supplanting some of the older incumbents like BT. There's some great competitive advantages. There's strong intangible assets, high switching costs, and all of this gives a very highly predictable and strong level of recurring revenues. I think it's about 90%. And all of this makes for a very strong investment case. So if we bring in the chart, you can see straight away the stock commands a much higher PE than the wider market on average. And if you remember that first chart I showed with the AIM market, this is largely what I've mentioned with a lot of growth potential on the cards here. But like that first chart, you can see it's been a victim of the macro story, with its PE falling from 38 to 15 times now. And it turns the outlook, it ties everything together very nicely. And with small caps and other listed stocks that have fallen victim to this story, as we discussed, eyes are on the catalyst to get things moving again, which we believe to be falling interest rates, normalized inflation. And just looking at Gamma, you can see it's trading at one of the most compelling multiples for years now. There's a lot of potential on the cards for upside growth with limited downside due to its current valuation support. And you see it across the market. So if your investors have that long-term investment horizon, you can absolutely capture the tailwind. And just to fit everything into the formula at the start that I mentioned, earnings for the company have been solid, growing 10% year on year. You're plus some 1.5% dividend yield. And finally, the potential for that upside Delta V. So all eyes on the catalyst to get things moving again, with investors flirting with the idea of rate cuts at some point this year. And one final thing, I'm conscious of time, Tom, just to summarize. Yes, we've used a formula to show how you can achieve an investment return, but really what we want you to think about is why we're doing it as well. It far extends just the R component here, earning a return. We're investing in solid businesses. We're creating real jobs in the UK. It's not just the companies, but the industries behind them, encouraging innovation, the real people within them. All of this boosts employment and growth for the UK economy. And I do really think that can be forgotten at times. It's such an exciting time for us as active investment managers as we get on to the next part of the cycle, and so much on the cards. So I think that's everything, Tom. So back over to you.
Josh, thank you so much. It's great to have you join me on this call, and clearly there's a very compelling case to consider AIM investing. Now, just to recap for everyone, we're going to bring this webinar to an end. So what have we covered? Have we prepared well? Do we have the training tools to have a varied training plan as we approach tax year end or as we approach a marathon run? So I've covered the venture capital market, specifically venture capital trusts. The VCT market is very buoyant. It's highly diversified, and there's some very, very good performing managers that gives advisors a lot of choice out there. And Blackfinch Spring VCT is absolutely one of them. We've talked about enterprise investment schemes, what you need to look out for when considering enterprise investment schemes. And we've talked about AIM and whether now is a good time to consider, and what makes it a very compelling time to consider the AIM market. The products that we've touched on, Blackfinch Spring VCT, housekeeping, it's open until the 3rd of April. We will be paying our first dividend from mid-April, and any applications received by the 3rd of April will be entitled to that dividend payment. We've talked about the Blackfinch Ventures EIS. Again, I mentioned it, but we are deploying into up to 15 companies before the end of the tax year, which is almost double the industry average of number of companies. Applications and received funds need to be with us by the 22nd of March. For both the VCT and the EIS, there are online and paper-based application forms available, so we do make it exceptionally easy to apply and actually allocate money into those products. And then we have an AIM proposition. Now, that AIM proposition is available inside an ISA, outside an ISA, and we have two portfolios, an income portfolio and a growth portfolio, both of which are actively managed, relatively concentrated, and have a very strong track record. Both myself and Josh are available to get out on the road to meet you in person or your wider team. So if you do want to hear more from us on the AIM side, please do let me know. We can arrange a follow-up meeting. There is a Q&A function in the webinar. If you've got any questions, stick it into that, and I'm happy to answer them. If there are no questions, it's been a pleasure hosting this session with all of you. Thank you for taking the time out of your diaries. We will be sending CPD certificates out post the call, and any feedback would be welcome and well received. But if there are no questions, thank you very much. It's been a pleasure, and I look forward to seeing you all at the next webinar we host. Thank you very much.
Thank you.